Welcome everybody. I'm Susan Kilsby, the agricultural economist at ANZ. Today I'm going to talk to you a little bit about what we're seeing in the global economy and then how that's impacting our own businesses and farms. So starting thinking of the global picture, at the moment there's a lot happening. There's a lot of uncertainty out there. And a lot of political uncertainty as well. Particularly, we're seeing this with the Russian situation in Ukraine, which is having flow-on impacts for our food production, for global food production, because they are a big food producing region, and also the energy markets because they supply a lot of gas and energy, particularly into Europe, and that's having impacts on our fertilizer market, which is also in turn impacting our food production in the global sense. We've also seen a lot of volatility in currencies. The New Zealand currency has depreciated a lot recently. That's useful for when we're looking at returns in New Zealand dollar terms at the farm gate level, but it does mean a lot of the costs of goods that we import have increased a lot. And talking about cost increases, inflation is certainly the topic of the day. We're seeing inflation running at incredibly high rates, both here in New Zealand and globally. And as a result of that, we're seeing central banks around the world trying to control that by tightening monetary supply, pushing interest rates up, with the expectation that this will impact consumer demand going forward and that consumer demand will ease off and therefore let inflation ease back. So if we look globally, don't worry too much about all the lines on this graph. What it is showing is that inflation is occurring at a rapid rate in most of the developed world. So not just New Zealand, but in other parts of the world, we're seeing really similar rates of inflation. And what's really driven this was earlier in the pandemic, there was the expectation that global economic growth would slow dramatically with all the responses needed to control COVID. But what we did see was a lot of additional stimulus provided by central banks and also by governments. And that really kept demand strong for our goods, but the supply chains just couldn't keep up. We had workers away, factories not operating at full supply, we had shipping issues. And so basically there was a shortage of goods, but there was strong demand for those goods. And this is the main factor that's driven inflation around the world. And we're certainly seeing here in New Zealand, just recently we saw the latest consumer price index data, which was much stronger than we expected. We're still well above 7%, and the Reserve Bank has a target of 1 to 3%. So we're way outside that range. So while we're in that situation, we're going to see the Reserve Bank continuing to do its best to tighten monetary policy, push up interest rates to try and rein in demand. So one way I look at how the global economies are tracking is using this shipping index. So the shipping index is measuring the number of containers that are going through our major ports around the world, and it's basically works as a proxy for demand for goods. And what we can see back in the global financial crisis, we saw a big, quite a sharp drop in demand, and then it took a few years before this demand improved, and we sort of climbed our way out of the hole that we were in. This time round, we have seen a slightly smaller drop, and then we're seeing this really quick bounce out as the demand was really stimulated by all the policies put in place by government and central banks. So the hole was nowhere near as large as we thought it was going to be, and demand has stayed reasonably strong, but that is also one of the reasons we're struggling with inflation globally. Shipping costs absolutely shot up during the pandemic, and that's also pushed up the cost of getting our goods to market and buying all of the imports that come into New Zealand. You can see on the graph, that shipping costs have come off quite sharply recently, and those global supply chain pressures have dropped back, not quite to pre-pandemic levels, but getting close to that point. Although the international shipping prices have come back quite sharply, we haven't seen such a big decrease in the price for shipping goods in and out of New Zealand. There are a few less ships on these routes now into New Zealand, and those that are coming are tending to only call it a fewer number of ports. So we're not seeing that sort of easing in our shipping costs for our own exports and our own imports just yet. But it's the prices certainly aren't going up. They are starting to come back. They're just not coming back as quickly as what we're seeing on some of the other major shipping routes. But this does indicate that demand relative to supply is starting to balance itself out again. If we look at the energy market, this graph is showing oil prices and graphing it against fertilizer prices. And the lines sort of move in similar trends. So when energy prices are high, fertilizer prices are high. And one of the reasons for that is that the synthetic fertilizers use a lot of energy, particularly gas, in their production. So at the moment, what we're seeing is energy shortages. Gas prices are still reasonably high, and that has restricted the amount of fertilizer that's been produced globally and has pushed up the price of fertilizer. We're only just starting to see those energy prices ease off a little bit now. So it's going to take quite some time before we see any reduction in the fertilizer prices that we're paying here in New Zealand. I'm generally expecting that autumn fertilizer prices will still be pretty strong, be similar levels to what we're paying now, but certainly by next spring we should start to see some softer prices for fertilizer. In terms of looking at what the Reserve Bank is doing in terms of its interest rate hikes, we're sitting at 3.5% for the official cash rate right now, and we're expecting this to trend up to 5%, so up another 1.5% by early next year. So we're forecasting that the Reserve Bank will do 2 75 basis point lifts, so 0.75%. At each of the November and February meetings. At the moment, we're just not seeing signs that inflation is decreasing, even though there are some indications that international supply chains are improving a little. But until the Reserve Bank actually sees that in our own inflation data, we don't expect they will ease rates. So we're expecting they'll be sort of full steam ahead for a wee while, and this will flow into interest rates that we all have to pay as well. In terms of the changes to our forecast, we've been constantly revising up our expectations for the official cash rate. Looking at this graph, you may think we look like we are well behind the chain. Certainly things have moved very quickly, but we've actually upgraded our forecasts probably more frequently than what we have seen from the Reserve Bank, and certainly been one of the first banks to keep ahead of it. But the markets move really, really quickly. Inflation's been much stronger than expected, hence why the need to continually revise up rates. Hopefully we're nearing the end of these upward revisions, but we'll have to wait and see how this inflation data turns out. So over the past few years, we've seen household debt as a percentage of income be relatively stable. It's been actually relatively stable for the past decade. Debt's gone up, but so have incomes. And the proportion of debt servicing, the proportion of people's income that they're paying on debt servicing has been trending down for the past decade, but that's now moving up really rapidly with these interest rate increases that are coming through. We don't expect it'll get to the levels that we saw back in 2008 before the global financial crisis, when quite a large share of income was having to be utilised to repay debt. We don't think we'll get quite those levels, but it is moving up very rapidly at the moment. In terms of looking at debt levels across New Zealand, and this is looking at data across all banks rather than just ANZ, what we can see here is that there's been a big increase through the pandemic in two sectors. One, the government sector. So the government debt increased quite dramatically, really as a result of some of the assistance they gave early in the pandemic around assistance for wages to keep people in jobs and the like. So we've seen a big uptick in government debt. We've also seen a big increase in the personal or housing sector debt. As lending for homes really increased. Now that's starting to ease off now, but we did see a big uptick in that through earlier in the pandemic. The business and agriculture sector has stayed relatively stable over the last few years. And if we look at the breakdown of primary sector debt in New Zealand, we can see that there's been quite a significant decrease in the dairy debt, as dairy farmers have taken advantages of the couple of seasons of quite good milk prices, and which has allowed debt levels to be reduced to sort of more sustainable levels. We're still expecting, a relatively high milk price this year, but with costs rapidly rising, we expect the amount of debt that is repaid this year will be less than what we've seen in the last couple of years. The sheep and beef sector has increased its debt a little, but not a whole lot. But there's been a big increase in percentage terms in lending to horticulture, particularly kiwi fruit, and also quite a lot going into the likes of avocados, as we see expansion in our horticulture sector in general. If we look across the world, global food prices have increased virtually across all sector. The sector here that's actually increased the most in a global sense was vegetable oils. So that's not something we export out of New Zealand. But the purpose of this graph is really just to show that it's been a really strong increase across all sectors. And that's certainly also been reflected in the ANZ Commodity Price Index, which hit record levels earlier in the year. And no one sector was at a record high, but it was just strength across so many different sectors that drove it to the levels that it was. I mean, in terms of this, vegetable oils went particularly high due to some restrictions in place on exports of vegetable oils from particular countries. And we have seen that sort of over the last couple of years, a little bit more protectionism as countries are looking after their own domestic markets. In terms of making sure they have enough food available and also fertilizer available. So we have seen some restrictions also in fertilizer exports to make sure countries have enough for their own needs. So that has reduced the amount of both food and fertilizer that's been available to trade globally. If we look at the share of our exports going to China, China is now a major market for most of the goods that we export. Certainly in the dairy industry, if we look globally, China buys more dairy products than probably about the next 7 largest dairy importing nations put together. So they're a significant part of that market. And certainly do buy a reasonably large proportion of our dairy products. About a third of our dairy products go to China. One of the big changes in the last few years has been the rapid increase in beef exports to China, and that means we're now exporting similar amounts of beef to the US and to China, whereas once upon a time most of our exports went to the US. So we were very reliant on that one market. Now we're a little bit more even across those sectors. I'm turning to the dairy sector. Farmgate milk prices have been pretty strong recently. This season we're forecasting an $8.75 milk price. So that's probably at the lower end of the range of forecasts that are out there at the moment. What we are seeing at the moment is that both global supplies of milk are relatively weak, but demand is also weak. So if we look at the year-on-year change in milk production across the major sort of dairy exporting countries, over the past year, that's been trending down. So it's below the line, so it's been producing less than the previous year. It's starting to ease back a little bit now, but the production's still relatively weak. But then at the same time, we're seeing demand just soften a little, and we've certainly seen that reflected in the last and the global dairy trade auctions that occurred through October, when we saw some reasonable sharp reductions in prices. So because milk supply is constrained, I don't expect prices will fall too much further, but yeah, the demand's weak, so that's just offsetting that. Hence why we've got a slightly weaker forecast than some of the other forecasts that are out there. There's still a little bit of room to move in my forecast in terms of reduction in commodity prices to still achieve that $8.75 milk price. We have been helped along a little bit by the weaker New Zealand dollar as well. Turning to the lamb market, if we look at the various lamb cuts that we sell into our international markets, the one cut that got impacted the most throughout the pandemic was our French racks. And that's because this product is very much orientated with the restaurant trade, and particularly the European restaurant trade. So when restaurants were closed during the lockdowns, we saw a sharp drop off in demand for that product. It's not a cut that's commonly cooked at home, so there was a big decrease in demand. But this particular graph is priced in New Zealand dollar terms, and more recently we have seen the demand pick up as all the restrictions have come off with COVID. Restaurants are operating normally again in Europe and most parts of the world, and that combined with the low New Zealand dollar has seen the price push right back up high again. But we have seen a little bit more weakness in the leg cuts and the forequarter cuts. So the leg cuts tend to be sold mainly into the UK and some into Europe. So, the slower economic growth there is having an impact, whereas the forequarter cuts and some of our other lamb cuts are mainly going into China. And it's just a little bit more challenging at the moment selling some of those cuts into both the European and Chinese markets at the moment, as economic growth is a little weaker and lamb is a relatively high priced protein. So looking ahead this season, we are expecting farm gate prices to be a little bit weaker than last year. So the dark blue line on this graph is last season's price, and the dotted line is our forecast for the year ahead. So we are expecting to be a little bit weaker, but because of the low New Zealand dollar and also I guess global shortages of protein, we don't expect prices to drop away as low as what we've seen in more recent years. Turning to the beef markets, throughout the pandemic, we've seen really strong prices for beef. But this was partly because of the fact that we have been able to sell beef into both the US and China. And it's generally worked out when access into one market has been more challenging, that the demand from the alternate market was quite high. So that's been pretty helpful. But what we've seen in the last few months is that the US has an oversupply of beef at the moment. They've had droughts there, and they've culled a lot of their own cattle, and that's meant prices have come back in that market. And we're also seeing, we're seeing reasonable demand from China, but just not as strong as what we'd seen previously. And without the competition from the US, we're just seeing prices come back a little bit in that market. But if we look at what that means for farm gate prices, this graph, if we look at the top line, this is looking at the international prices, whereas the dark blue line is looking at the prices that we get paid here for stock leaving our farm going to the works. And you can see that internationally prices have been coming back, but locally prices are still been firming. And the main reason for that is at this time of the year, we just don't have a lot of stock to process. So we're still seeing some firming of prices. We also saw a bit of a gap open out between those lines, which indicates either the meat companies are making slightly stronger profits, and they have done that, and also their operating costs are going up as well. So their cost of labour and their cost of shipping is going up. So these lines are sort of getting a little bit, the relationship's changed a bit in recent years. But if we do see international prices continue to weaken, then as we start to see more stock come through the works here, you would expect to see prices ease back again, because they won't be able to sustain that over the longer term. Certainly one factor that's been quite helpful in terms of returns back in New Zealand dollars, whether it be returns for our horticultural produce we're selling into international markets, or our meat or our milk or our logs, is the fact that the New Zealand dollar has weakened substantially. So that means the returns are higher when we translate them into New Zealand dollar terms. But it does mean that the costs of anything we're importing, particularly fuel, fertilizer, and machinery, are higher because of the weaker New Zealand dollar. There's a number of factors that can drive the New Zealand dollar, but at the moment, the main dominant factor really is just the high level of global uncertainty there is in the markets at the moment. And in that environment, you tend to see people flock into investing in the US currency. It's a bit of a safe haven. And so as a result, the New Zealand dollar depreciates because the value of the US dollar is being pushed up. So it's having very little to do with what's actually happening here in New Zealand at the moment, but more to do with the international volatility is why our dollar is lower. So where are we trending to from here? So over the shorter term, we expect to see continued inflationary pressure in the short term, although there are some international signs that may be just starting to ease. But we do expect to see the Reserve Bank continuing to push up the official cash rate and push up interest rates into early next year at least, with another 1.5% increase in the official cash rate expected at this point. Food prices are being supported by the fact that there's not a lot of food being produced globally. There's been some drought issues in recent years, and that has restricted the amount of goods being produced. And so that will underpin pricing to a certain extent, but we're also seeing on the other side, we're seeing global economic conditions deteriorate, consumers becoming more wary. So that's putting downwards pressure on prices. So we expect overall, in general, prices to be a little bit weaker than what they were last year, but not fall significantly. Over the longer term, some of the trends we're seeing in terms of food production is a trend towards more sustainable production. Certainly, the way food is being produced is not sustainable at the moment. If you look in a global sense, and some countries are running out of resources, and particularly water shortages is going to be a big challenge going forward. And that's actually one advantage New Zealand has, because we aren't short of water here in New Zealand. We are a little bit short of water storage to have the water available at the right place at the right time, but we're certainly not short of the raw resource. So capturing that will be one of our challenges going forward as we continue to produce food. The other aspect is really understanding our customers and becoming more connected to our customers. Understanding what their needs are and their values are will really help us make on-farm decisions on how we run our farms, and will help us achieve premiums for if we can tap into the customers who like the way that we farm here in New Zealand. So that's one of our opportunities. I do think we will see a lot more contracted supply right throughout the supply chain over the longer term, as we try and link right through the supply chain, and which will provide more certainty, and it will also provide more differential farm gate pricing. So we won't necessarily have one milk price going forward or one lamb price. There'll be a much greater range depending on which market we're tapping into, and how we're producing food on farm. So a few challenges in the shorter term, but certainly the long-term future is looking quite bright for our agricultural sector. So thanks for listening today. It's been a pleasure bringing you this update.